We now have with us our old friend Rahul Arora, CEO of Nirmal Bang Institutional Equities. Of course, Rahul, hi, good morning. We haven't called you because you are an old friend. We've called you because you are the CEO of a brokerage and you have some views on the market. So let's talk about the market. You have been bullish in the past when I've spoken to you. First up, how does it feel being in the studio after 6 years? And secondly, what's your market call?
Very nostalgic, Anuj, and thanks so much to you guys for having me on the show. It did bring back a lot of memories, climbing up the stairs and coming into the studio, I must confess. But glad to be back and sitting with you guys. As I heard you guys talking about rightly, I think most of our clients as well have been bullish coming into 2014. And that was the stated call that we had also when we put out our strategy piece in March last year. We were calling for a 7,000 Nifty by March of 14. As of this point, we have not changed that call, although it is under review, I must confess. A couple of things that have changed for us, as you were pointing out, 6150 has become some sort of an important level even in the fund manager community. And the fact that you've seen FI selling over the last couple of days close to this level is making people a little bit jittery. Add to that, I think the fact that a lot of the noise that you had around the BJP wanting to win the elections, which was the canter in the last quarter of the last calendar year, has seemingly receded a bit. So I think there are a couple of variables just at the cusp of earnings season that are probably going to advise caution at this point in time and not just irrational exuberance, sort of assuming that Nifty would head to 7,000 just on an election wave.
Okay, Rahul, congratulations on being back in the studio. But, you know, I was just reading a couple of your picks. You did mention that IT and pharmaceuticals would be something that you would be bullish on going into 2014 as well. Don't you think that to some level in 2013 there's a little bit of frothiness which has come into the sector, or do you see incremental upside coming in?
I think that's a valid point that you make, but I think on a relative basis, if you try and look for earnings growth beyond some of these sectors, I don't think the confidence level is there just yet. So through our own channel checks, when we meet companies in the commodity space, when we meet people in capital goods engineering, even autos for that matter, that sense of confidence on growth is not coming back just yet. And I think the trade seems to have, or the street seems to have sort of given up on the fact that the rupee can depreciate from here substantially. I think some of the variables that have been spoken about, whether it's the US tapering, and let's not forget that nearly 42% of the world goes to elections in 2014. And some of the key competitors that we have that fight for capital, including Indonesia, for example, actually also go to elections this year, and some of the other emerging markets as well. So I think there's going to be a fight for capital in 2014. India is not the only exception that's going to elections this year, because a lot of the froth has come into the system because of that, I believe. But on ground, I don't think the capex cycle is anywhere close to reviving from our own channel checks, which is what leads me to believe that probably the trade for 2014 will be a strengthening US dollar, a weakening US rupee. I can't foresee it going to 70 yet or 68, but I think definitely it will probably weaken from where it is currently. And at the margin, if you see a US recovery, I think these stocks will continue to do well, in addition to the point you were making that they've already done well. So I think it's probably a polarization of valuations that will continue to exist in 2014 as a continuation of what you saw last year.
Yeah, Rahul, let's talk about the broader market now, and let's talk about stocks, because this is what our audience wants to know. Last year, you, I think, came out with subscribe note on Just Dial. Are you surprised by the phenomenal move that we've seen on Just Dial? And what are you advising your clients now on this particular stock?
Anuj, we actually put the stock under review now, because last week the stock went to well in excess of 1,650 and it was trading at 80 times 1 year forward PE and 20 times sales. So it does make an investor jittery. I don't think there is too many other companies that have tripled your money in a 6-month horizon the way Just Dial has, and it's about an 11,000-12,000 crore market cap company at this point in time. We have spoken to some of the SME guys who actually advertise on Just Dial, and we got a sense that the ROEs that they enjoy are quite phenomenal. But I think at about 1,650, 1,700, which is the price that you saw last week, a lot of it may have actually been in the price. I would not advise people to come in and buy fresh into Just Dial right now. Having said that, if you are an existing shareholder, it may not be imprudent to take some profits, but continue to keep a little bit on the table, because the fact is that they're getting into high-end transaction value-based services right now, which could be the next earnings kicker that you probably see towards the back end of FY15 getting into 16. So a fresh investment into Just Dial probably does not warrant itself at this market cap and at this market cap to sales or PE. But like I said, if you are an existing shareholder, probably take some profits off the table, but keep holding on some, because there are some metrics in the company that are changing.
Rahul, correct me if I'm wrong, but you are underweight in capital goods as a sector, but you like Voltas. Your rationale?
See, in the case of Voltas, if you see, one of their largest projects that they had in the Middle East had a cost overrun because the entire design of the project was changed. I think if you go back to the con calls that Voltas has been having, about 94% of that has already been booked, and there's just a little bit left to be booked. And the quarterly run rate that Voltas does by way of its order intake historically is what they're continuing to do here on as well. Our understanding with the interactions that we've had with the management is they want to get out of the design phase of projects, which is what actually cost them in this one project that they had from Qatar, and they're just focusing on the delivery and the operational aspect of it. Our call on Voltas is predominantly a revival in their engineering division, where the margins had dropped about 1–1.5%. We're actually seeing a revival of that to about 4–4.5% by the end of FY15. So it's more a margin recovery play with the standard order book intake that they have, vis-a-vis the sort of clarity that we have on some of their other competitors in the sector.
What's the story on a couple of these picks that you have, La Opala and Supreme Industries?
La Opala, Anuj, is a very interesting story. I don't think it's a stock that's covered on the street.
That's why I'm asking you.
It's about a $100 million market cap company. It caters to the organized retail on the crockery side.
Yes.
So I actually happened to make my first purchase of the product only in Diwali this year because we actually covered the stock. But it's interesting. It's a company that enjoys 30% kind of RoCs and RoEs. It's a company that actually throws up cash. Although it's not caught the fancy of people because probably it's not a very liquid stock and the market cap is just about $100 million. But the interesting part about La Opala is that the addressable market for the company is just 1,000 crores. It does not do anything in steel crockery yet, and it's not an end-to-end dinner set provider. So the addressable market for a La Opala is actually 7,000 to 8,000 crores. And right now, only 1,000 crores is what he addresses, of which 50% is organized. So the organized market that he caters to is 500 crores, of which his top line is about 150–200 crores. So I think the scale of expanding across India as he grows his product range is tremendous. And that's why I think that stock, even though it's done remarkably well, we have seen some institutional activity in the stock over the last couple of months. And I think this could be one very interesting stock for retail as well as institutional investors who have a small cap fund or appetite for smaller stocks.
And what about Supreme Industries?
Supreme is a very interesting play. I mean, if you look at Astral, it's done really, really well. Although Supreme, perhaps I would say 20–25% lower than where it is currently. But I think if you analyze all the product profiles of Supreme, all the verticals that it has, the margin profile is extremely strong. The order book is extremely strong. The management bandwidth is really, really good. Very strong return ratios again. And that's the one, Anuj. I think we're actually looking at stocks which enjoy high RoEs, high RoCs, reasonably good corporate governance, companies that are throwing up cash. And Supreme is one of those stocks that has done really well for investors over the years. So probably not at this price. If you get it 20–25% lower, I think it could be a great investment to have. And not just that, if you allow me, since there is one stock that's really doing well today, Cadila Healthcare is another one that we're really positive on. In fact, we did meet with the management about 15 days back. We came out with a visit note. We upgraded it. That's another one that looks pretty interesting to us from the pharmaceutical space.
All right, Rahul, must say it was good having you in the studio.
Likewise.
I think after 6 years, so good to have you in the studio.
Thank you so much.
And thanks a lot for your views. That's a